have been taught that a high balance in your savings account is the ultimate symbol of financial security. That is a carefully constructed lie. The banking system relies on your need for safety to fund its own aggressive expansion, while you are locking your wages in a vault, praying to outpace inflation with a fractional interest rate. The architects of wealth are doing the exact opposite. They are not saving, they are borrowing. Let us look at the mathematics of the middle-class trap. You trade your time for a wage. The government takes its share right off the top through income tax. You take what is left, pay your living expenses, and place the remainder into a savings account. At the end of the year, the bank pays you a yield, and then the government taxes that yield. You are taxed on the way in, and you are taxed on the way out. Meanwhile, inflation quietly erodes the purchasing power of that stagnant capital. You are playing a game where the rules guarantee your slow mathematical defeat. So if saving your capital guarantees a loss, what is the alternative? How do the ultra-wealthy bypass this cycle entirely? The answer lies in the mechanics of structural debt. To the wage earner, debt is a consumer trap. It is a credit card balance used to buy depreciating liabilities. To the wealthy, debt is a tax-free instrument of acquisition. When you borrow money, that capital is not recognized as income by the IRS. There is no tax on a loan. The 1% use this principle to build a tax shield. They acquire income-producing assets, real estate, private equity, or dividend-paying equities. Instead of selling those assets and triggering a massive capital gains tax, they borrow against them. They extract the liquidity they need to live, tax-free, while the underlying asset continues to compound. The asset appreciates faster than the interest rate on the loan, creating a perpetual motion machine of wealth. But this raises an uncomfortable question. If the wealthy are using debt to get richer, who is funding their loans? The money sitting in your savings account is not sitting in a vault. The bank is legally permitted to lend out a massive multiple of your deposits. They pay you a fraction of a percent, lend your money to an investor at a higher rate, and pocket the spread. You are absorbing all the inflationary risk, while the bank and the asset owner reap the rewards. The system is designed to transfer wealth from the cautious saver to the strategic borrower. To break out of this cycle, you must stop thinking like a depositor and start thinking like a bank. This is the bridge between wage and wealth. It requires a fundamental rewiring of your financial psychology. You must stop trading your time for a wage just to park it in a depreciating holding cell. You must begin converting your active income into passive assets. You acquire assets that generate cash flow. You use that cash flow to service strategic low-interest debt. You use that debt to acquire more assets. This is not about getting rich overnight. It is about understanding the cold mechanical reality of how capital actually moves through the global economy. The wealth gap is not a result of who works harder. It is a result of who understands the math. You can continue to play by the rules designed for the employee, or you can learn the systems engineered for the owner. The choice is yours. The crushing weight of consumer debt is a psychological prison. You wake up every morning knowing a portion of your day is already spoken for by a creditor. You are working to pay for the ghost of yesterday's consumption, a car that depreciated the second you drove it off the lot, a vacation that lives only in photographs. This is the emotional toll of playing the wrong side of the debt equation. It breeds anxiety, forces compliance, and keeps you tethered to a job you despise just to service the interest on liabilities masquerading as assets. Now contrast that with the mindset of the owner using leverage. There is no anxiety, only calculated expansion. When an owner takes on debt, they are not buying a lifestyle. They are buying time and capacity. The debt is a hired gun. It goes to work in the marketplace, captures a yield, pays its own interest, and brings the surplus back to the master. The owner sleeps soundly because the asset is servicing the debt, not their personal labor. They have detached their survival from the whims of a monthly paycheck. To make this shift, you have to redefine what money actually is. The worker views money as a reward for time spent. It is a finite resource to be hoarded in a bank account or traded for immediate comfort. But the owner views money simply as a unit of capital. Capital is not a reward. Capital is ammunition. It is a raw material that exists solely to be deployed into the machinery of the economy to capture more territory. When you stop seeing dollar as a measure of your personal worth and start seeing them as workers on a factory floor, the game changes. You stop asking what you can buy with your money. You start asking what your money can acquire that will pay you forever. This is the pivot from consumer consciousness to capital consciousness. It is the exact moment you stop being the fuel for the machine and start becoming the architect of it. Look at the physical landscape of wealth around you, the towering commercial real estate developments, the sprawling industrial parks, the massive logistics hubs. None of these were built with saved cash. They were willed into existence through the strategic application of capital and debt. The environment we live in is a monument to leverage. It is a physical manifestation of borrowed money being converted into tangible, cash-flowing reality. Every skyscraper piercing the skyline represents a syndicate of investors who understood how to borrow at a low rate and build at a high return. The concrete and steel are just the physical shell of a massive financial equation. The people walking into those buildings to work 9 to 5 are paying the lease. The lease is paying the commercial mortgage. The surplus is enriching the owners who orchestrated the leverage. The entire environment is a silent wealth transfer mechanism operating in plain sight. This brings us to the core engine of the global economy, the capital allocation system. The financial system is not a chaotic casino. It is a highly ordered distribution network designed to move money away from those who let it sit idle and toward those who put it to work. Banks are the central nodes in this network. Their primary function is to aggregate the stagnant savings of the working class and allocate it to the asset-acquiring class. The allocation system rewards efficiency and punishes stagnation. If you leave your capital parked in a checking account, the system penalizes you through inflation. Your purchasing power is silently siphoned away to subsidize the expansion of the economy. But if you step into the arena as an allocator, the system bends to support you. It offers you tax incentives, depreciation write-offs, and access to other people's money. The system is rigged, but it is rigged in favor of anyone willing to learn its language. The mechanics are ruthlessly straightforward. An investor identifies a distressed multifamily property. They do not use their own cash to buy it outright. They approach a lender with a business plan. The lender looks at the projected net operating income and agrees to fund 80% of the purchase price. The investor puts down 20%, takes control of the asset, and immediately forces appreciation by increasing rents and decreasing expenses. The property value spikes. Now the investor executes a cash-out refinance. They go back to the bank, appraise the newly stabilized asset at its higher value, and pull out a new loan. This new loan pays off the old debt and returns the investor's initial down payment completely tax-free. Because the IRS does not tax borrowed money, the investor now owns a cash-flowing asset with zero of their own money left in the deal. They take that return capital and repeat the exact same process on the next property. The ultimate consequence of this strategy is the creation of a collateralized empire. The wealthy do not sell their assets to generate cash because selling triggers a massive capital gains tax. Instead, they borrow against their assets. They use their stock portfolios, their real estate holdings, and their business equity as collateral to secure lines of credit. They live on borrowed money at a 4% interest rate while their underlying assets grow at an 8% rate. This is the permanent escape velocity of the ultra-rich. They buy, borrow, and die. When they pass away, the assets transfer to their heirs with a stepped-up cost basis, wiping out generations of taxable gains in a single keystroke. The debt is settled by the estate, and the cycle begins anew. They have weaponized the very thing that bankrupts the working class. Debt is the invisible architecture of generational wealth, and until you learn to wield it as a tool, you will forever be its victim. You have been programmed to believe that a high salary is the finish line, that if you just negotiate a 20% raise, max out your retirement accounts, and skip the luxury vacations, you will eventually cross the threshold into true wealth. It is a mathematical illusion. A six-figure income does not make you rich. It makes you a highly compensated cog in a machine designed to extract your time and tax your labor at the absolute highest marginal rate. The ultra-wealthy do not care about income. They care about assets, and the mechanism they use to acquire those assets is the exact thing you have been taught to fear. Let us look at the cold mechanics of the wealth gap. Society tells you debt is a sin. Pay off your mortgage. Cut up your credit cards. But if you look at the balance sheets of the top 1%, they are swimming in liabilities. The reason is simple. The tax code punishes wages and rewards structural debt. When you earn $1 through a W-2, the government takes its cut before the money even hits your bank account. When you borrow $1 against an asset, it is completely tax-free. This is the great divider between the working class and the owning class. The working class sells time for taxable income. The owning class buys cash-flowing assets and uses strategic leverage to extract tax-free liquidity. They do not earn money to buy things. They buy assets that borrow money to buy things. But acquiring the asset is only half the equation. The real acceleration happens when you shield it. There is a reason the rich buy commercial real estate and heavy machinery, and it has nothing to do with being a landlord or a manufacturer. It comes down to a phantom expense that legally erases their tax liability. It is called depreciation. In the world of wage earners, depreciation is what happens when you drive a new car off the lot and lose $5,000 in market value. It is a pure loss. In the world of wealth, depreciation is a calculated tax shield. When you own a commercial asset, the IRS allows you to deduct the theoretical wear and tear of that asset against your actual income. You could have a property generating positive cash flow every single month, putting real dollars in your pocket, while simultaneously reporting a paper loss to the government. Your EBITDA looks incredibly healthy to a bank, allowing you to borrow more capital, but your taxable income zeroes out. You are legally invisible to the taxman. This is not a loophole. It is the government heavily incentivizing individuals to provide housing, energy, and infrastructure. They are outsourcing societal development to private owners and rewarding them with tax immunity. If you rely solely on a salary, you are entirely locked out of this ecosystem. So how do you cross the bridge? How do you stop trading finite hours for heavily taxed dollars and start building an autonomous balance sheet? It requires abandoning the most celebrated financial virtue of the middle class. You have to stop saving cash. Cash is a melting ice cube. Inflation is a silent, unlegislated tax that systematically transfers purchasing power from savers to debtors. If you leave your capital sitting in a traditional savings account, you are guaranteeing a negative real return. The transition from wage earner to owner requires converting your active income into passive equity as fast as mathematically possible. You must understand the opportunity cost of lifestyle inflation. Upgrading your lifestyle with your first major bonus does not just cost you the $10,000 you spent. It costs you the compound interest that $10,000 would have generated over 3 decades of market exposure. The wealthy do not buy luxury liabilities with their principal. They buy income-producing assets, and they let the cash flow from those assets fund their lifestyle. The principal is sacred. It is the engine. You never dismantle the engine to buy the paint job. The financial system is not broken. It is functioning exactly as it was engineered to function. It rewards ownership, leverage, and capital allocation. It penalizes labor, consumption, and idle cash. You can spend the next 30 years trying to climb a corporate ladder, fighting for incremental raises that will immediately be swallowed by higher tax brackets and inflation. Or you can step off the treadmill. Learn the mechanics of structural debt. Build a tax shield. Stop working for money and start building the systems that make money work for you. The math does not care how hard you work. It only cares who owns the equity. Let us look at the raw mechanics of interest. For the worker, interest is a penalty. It is the premium you pay for consuming before you produce. When you swipe a credit card at a 24% APR to buy a depreciating asset, you are selling your future labor at a massive discount. You are locking yourself into a contract where your future hours are already spent. The bank calculates exactly how much of your paycheck they can siphon off without bankrupting you. For the owner, interest is not a penalty. It is a calculated cost of capital. When an investor borrows $10 million at a 5% interest rate to buy a commercial property yielding 8%, the interest is just a line item. The bank is essentially funding the acquisition of an asset that pays for its own debt. The owner captures the spread between the cost of the debt and the yield of the asset. The debt is doing the heavy lifting, while the owner reaps the equity growth. This brings us to the ultimate systemic advantage. The tax code is not a rule book for how to pay the government. It is a map of incentives. When a worker pays interest on a credit card or an auto loan, they pay it with after-tax dollars. They have to earn $1, pay 30% in taxes, and use the remaining 70 cents to service the debt. The math is brutal. It ensures the worker is constantly bleeding capital from both ends. The owner plays an entirely different game. When a business or an investor pays interest on a loan used for income generation, that interest is tax deductible. It reduces their taxable income. The government is effectively subsidizing the cost of the owner borrowing money. The debt creates a tax shield. You borrow money to buy an asset. The asset generates income, and the cost of the debt wipes out the taxes on that income. It is a closed loop of financial efficiency. Realizing this truth is often a bitter pill. You were taught to fear debt. You were told to pay off your mortgage, cut up your credit cards, and live completely debt-free. That advice is designed to keep you safe, but it also keeps you small. It is advice meant for consumers who cannot control their impulses, not for strategists building empires. When you realize that the wealthy are using the exact same financial instruments you fear to multiply their net worth, the illusion shatters. The anger you feel when looking at your tax bill is justified. You are playing by a set of rules that were written to extract your wealth. You sacrifice your time, you pay your taxes up front, and you save the scraps. Meanwhile, the owners are borrowing against their assets, paying zero taxes on the loan proceeds, and using the tax code to write off the interest. They are not cheating. They are just reading the actual rulebook while you are following the folklore. To cross over to the winning side of this equation, you must understand asset-backed lending. This is the final frontier of wealth mechanics. You do not need a massive salary to live like the ultra-wealthy. You need a portfolio of assets that a bank is willing to lend against. When you have equity in real estate, stocks, or a private business, you no longer need to sell those assets to access cash. Selling triggers capital gains taxes. Selling stops the compound growth. Instead of selling, you borrow. You pledge your assets as collateral and take out a line of credit. This is the strategy known as buy, borrow, die. You buy assets that appreciate. You borrow against them to fund your lifestyle or buy more assets. Because loan proceeds are not classified as income, they are completely tax-free. You get the cash, you keep the asset, and you pay nothing to the IRS. Step into the world of the family office and the private bank. Here, debt is a bespoke instrument. Billionaires do not take a salary. Taking a massive salary is a rookie mistake that triggers a 50% tax bracket. Instead, they hold billions in stock and secure a pledged asset line at a floating interest rate of maybe 3 or 4%. They live on the borrowed millions. The underlying stock grows at 8 or 10% a year, vastly outpacing the cost of the loan. The debt never actually has to be paid back during their lifetime. When the owner passes away, the assets transfer to their heirs under current tax law. Those assets receive a step up in basis. The capital gains tax is wiped out completely. The heirs can sell a fraction of the newly stepped up assets to pay off the original loan and pocket the rest of the empire tax-free. The debt was nothing but a temporary bridge across the tax code. This is the architecture of modern wealth. It is cold, it is mathematical, and it is entirely legal. Debt is the lever that moves the financial world. If you use it to buy televisions and cars, it will crush you into a lifetime of wage slavery. But if you use it to acquire cash-flowing assets, it becomes the ultimate tool for liberation. Stop fearing the mechanics of money. Master the leverage, build your tax shield, and take your place on the right side of the balance sheet. The ultimate financial flex of the middle class is a paid-off mortgage. It feels like freedom, but in the architecture of modern wealth, zero debt is a massive liability. You have been conditioned to fear debt by a system that relies on you not understanding how it actually works. The ultra-wealthy do not pay off their houses. They do not strive to be debt-free. They weaponize debt to multiply their net worth while legally shrinking their tax bill to zero. If you are still trying to save your way to wealth, you are playing a game with rules designed to make you lose. The question isn't how to avoid debt. The question is how to use the exact same financial mechanics the top 1% use to buy time, assets, and leverage. You pay ordinary income tax, which is the highest tax rate in the system. You take what is left, pay your living expenses, and put a fraction into a savings account, earning a yield that barely outpaces inflation. This is the script you were handed. It guarantees you will work until you are old. The mathematical reality of compound interest dictates that capital needs velocity. When you lock your money inside the equity of a primary residence or let it sit idle in cash, its velocity drops to zero. You suffer the invisible tax of opportunity cost. Every dollar trapped in debt equity is a dollar not acquiring cash-flowing assets. But if the middle class is trapping their wealth in paid-off homes and savings accounts, where are the wealthy putting theirs? The answer lies in a mechanism banks rarely advertise to the retail consumer. The wealthy do not sell assets to generate cash. Selling triggers capital gains tax. Selling diminishes the compounding base. Instead, they borrow against it. They use a strategy built on acquiring an appreciating asset, taking out a line of credit against that asset, and using the borrowed, tax-free money to fund their lifestyle or buy more assets. Debt is not taxed as income. Let that sink in. A billionaire can borrow $10 million against their portfolio and pay exactly 0% in income tax on that cash. The interest rate on that collateralized loan is a fraction of what they would pay in taxes if they sold the asset. The underlying asset continues to compound, often outpacing the low interest rate of the loan. The debt becomes a tax shield. The asset pays for the debt. This isn't a loophole. This is the structural foundation of global finance. So how does an employee transition into an owner using this exact same logic? You stop viewing debt as a moral failing and start viewing it as a financial instrument. Bad debt is borrowing money to buy liabilities like cars, clothes, and vacations. Those things bleed value. Good debt is borrowing money at a fixed rate to acquire assets that produce yield or appreciate faster than the cost of the capital. Inflation inflation destroys the purchasing power of the dollar, but it also destroys the real burden of fixed-rate debt. When you hold a mortgage at a low APR, inflation is actively paying off your loan. The money you owe tomorrow is worth less than the money you borrowed yesterday. By aggressively paying down low-interest debt, you are destroying your own capital base to give the bank a bailout. You are trading liquid, investable cash for illiquid equity. The transition from wage earner to wealth builder requires a complete psychological reset. You must stop optimizing for comfort and start optimizing for leverage. Wealth is not created by hoarding pennies. It is created by acquiring assets, controlling capital, and understanding the mathematical mechanics of the tax code. The banking system is a machine. You can either be the fuel that powers it or the engineer who directs it. The choice comes down to whether you want to work for your money or force your money to work for you. The psychological weight of debt is designed to keep the working class paralyzed. You were raised to believe that owing money is a moral failure. It is drilled into you from childhood that financial freedom means being completely debt-free. This is a calculated deception. It is a narrative engineered to keep you trading your finite time for heavily taxed wages. When you fear debt, you refuse to use the very tool that could buy back your freedom. For the average worker, debt is a source of suffocating anxiety. It keeps you awake at night. It dictates where you live, what you eat, and how much abuse you will tolerate from an employer. This fear is entirely justified when your debt is tied to depreciating consumer goods. When you borrow to consume, you are chaining your future labor to your past desires. You become an indentured servant to your own lifestyle choices. The wealthy experience none of this anxiety. To the owner class, debt is completely devoid of emotion. It is not a burden. It is a mathematical input. They do not lose sleep over a $10 million commercial loan because their personal labor is not required to pay it back. The asset pays the debt. The emotion is stripped away, leaving only cold, calculated leverage. The fundamental difference lies in the debt-to-equity ratio. This single metric separates the financial predators from the prey. The working class focuses entirely on income and expenses. The wealthy focus entirely on assets and liabilities. They understand that a high debt load is not inherently dangerous if it is offset by high-quality cash-flowing equity. When your debt is backed by nothing but your future wages, you are incredibly fragile. A single layoff destroys your ability to survive. But when your debt is backed by productive assets, you become financially bulletproof. The debt-to-equity ratio becomes a dial you can turn to accelerate your wealth. You are no longer relying on your physical energy to service the loan. Look at the physical environment around you. The skyline of every major city is a towering monument to leveraged capital. Those massive skyscrapers of glass and steel were not built by saving up wages. Every sprawling logistics center, every industrial park, every data farm is heavily financed. The physical world of commerce is built entirely on good debt. Institutions do not hoard cash to build infrastructure. They secure financing. They lock in long-term debt to acquire real estate, knowing that the yield will outpace the cost of capital. The corporate balance sheet is a masterclass in using borrowed money to accumulate hard assets. They understand that cash is trash when inflation is eroding its value by the minute. The global financial system is explicitly designed to reward this exact behavior. Central banks manipulate interest rates to encourage borrowing by those who hold collateral. The entire economy runs on credit expansion. The system does not want you to save your money in a mattress. It wants capital to circulate, to be deployed, and to be leveraged into productive enterprises. Fiat currency is quite literally created through the issuance of debt. When a bank issues a loan, new money is injected into the economy. Wealthy owners understand this mechanical truth. They know that by taking on productive debt, they are positioning themselves on the winning side of fiat currency creation. They are surfing the wave of inflation instead of drowning in it. The procedural mechanics of this strategy are ruthlessly efficient. You take out commercial debt to acquire an income-producing asset, like an apartment complex. You use a fraction of your own capital as a down payment. The bank provides the rest. You now control a massive asset using mostly other people's money. This is the essence of financial leverage. The tenants go to work every day to pay your monthly mortgage. Meanwhile, the tax code allows you to depreciate the physical building. This paper loss shields your real cash flow from the IRS. You collect rent, pay down the principal, and owe little to nothing in taxes. When the property appreciates, you refinance, pull out tax-free cash, and buy another building. The consequence of mastering this leverage is exponential, unstoppable wealth generation. You are no longer bound by the limits of your own time or energy. You are using the bank's capital to acquire assets, the tenant's labor to pay off the debt, and the government's tax code to protect your profits. You have built a self-sustaining machine. Those who refuse to understand this mechanism will spend their entire lives paying for those who do. The working class will continue to rent the assets that the owner class financed with debt. Leverage is the ultimate dividing line in the modern economy. It is the cold, mechanical reality of how empires are built, and it is the only true escape velocity from the wage trap you have been lied to about the ultimate financial goal. Society tells you that paying off your house, cutting up your credit cards, and living completely debt-free is the finish line. That is the finish line for the working class. For the wealthy, zero debt is a mathematical failure. The system is designed to keep you afraid of leverage. You work 40 hours a week, pay the highest possible tax rate on your W-2 income, and then use whatever pennies are left to aggressively pay down a low-interest mortgage. But safety is the most expensive luxury in the modern economy. While you are locking your liquidity inside a brick-and-mortar savings account that produces zero yield, the financial elite are playing an entirely different game. They do not fear debt, they weaponize it. So why do the ultra-wealthy constantly borrow money when they already have millions in the bank? The answer lies in a mechanic called the tax shield, and understanding it is the first step to crossing the chasm from employee to owner. Let us look at the cold math. When you earn $1 through a paycheck, the government takes its cut before you even see it. When you borrow $1, it is entirely tax-free. The wealthy do not sell their assets to fund their lifestyle because selling triggers capital gains tax. Instead, they use their assets as collateral to borrow against them. They access millions in liquidity, pay zero income tax on that money, and let the underlying asset continue to compound. But the real magic happens when you factor in the silent thief in your bank account. You are taught that inflation destroys your purchasing power, and if you are hoarding cash, it absolutely does. But what if I told you inflation is actually the greatest wealth-building tool for those who know how to position their liabilities? Think about structural debt. If you secure a fixed-rate loan at 4% and inflation runs at 5%, the real cost of your debt is negative. The bank is mathematically paying you to hold their money. You are paying back yesterday's debt with tomorrow's devalued dollars. The middle class uses debt to buy depreciating liabilities like luxury cars and oversized televisions. The wealthy use debt to acquire cash-flowing assets. They let the tenant, the business, or the dividend pay the interest while they capture the equity upside. It is a closed-loop system of manufactured wealth. But accessing this system requires a fundamental shift in how you view your personal balance sheet. You have to stop thinking like a consumer and start thinking like an institution. So how do you actually restructure your financial life to mirror the 1%? It begins with opportunity cost. Every dollar you use to pay down low-interest debt is a dollar that cannot be deployed into a high-yield environment. If your mortgage costs you 4%, but a broad market fund yields an average of 8% over a decade, accelerating your mortgage payments is actively destroying 4% of your potential net worth every single year. You are trading mathematical growth for a psychological safety net. True wealth requires separating your emotions from your capital. You must optimize for compound interest, not comfort. Build liquidity. Maintain excellent FICO scores to access cheap capital. Secure assets that generate yield and use strategic leverage to amplify those returns. The divide between wage and wealth is not about who works harder. It is about who understands the mechanics of money. The hustle culture industry wants you exhausted, grinding for a promotion, and saving your way to a mediocre retirement. The reality is far colder. Wealth is not built by trading time for money. Wealth is built by acquiring assets, leveraging the tax code, and letting the financial system do the heavy lifting. The rules of the game are hidden in plain sight. It is time you started playing to win. The fundamental consequence of starting with nothing is that you have no collateral. When you lack assets, the only thing you can pledge to a lender is your future labor. This is why consumer debt is so brutally expensive. You are borrowing unsecured capital to buy depreciating liabilities, and you are guaranteeing it with the sweat off your own back. The bank knows the risk of your unemployment, so they price that risk into your interest rate. You are paying a premium simply for being vulnerable. The owner operates in a completely different reality. They do not pledge their time. They pledge their assets. When you use real estate or an investment portfolio as collateral, the bank feels secure. They offer rock-bottom interest rates because they know if you default, they can simply liquidate the asset. The physical labor of the owner is completely detached from the transaction. This collateralized leverage allows them to acquire even more assets without ever risking their personal time or daily survival. The psychological toll of this disparity is devastating for the worker. Unsecured debt creates a low-grade chronic panic that dictates every life decision. You stay in a toxic job because you need the paycheck to service your credit cards. You swallow your pride and cancel your vacation because the auto loan is due. The debt becomes a physical weight, a constant reminder that your future time has already been sold to an institution. It is a modern form of indentured servitude, masked by the illusion of consumer choice. Contrast that with the emotional detachment of the wealthy. When your debt is collateralized by a cash-flowing asset, the anxiety vanishes. The owner does not worry about making the monthly payment because the asset yield covers the cost of the loan automatically. There is no midnight panic about missing a shift or getting laid off. The debt is just a line item on a spreadsheet, quietly working in the background to amplify their net worth. The psychological freedom is absolute. This dynamic exposes the core hypocrisy of the lending industry. Banks are not public utilities designed to help you build a life. They are profit engines designed to extract yield. They actively avoid lending to people who actually need the money to survive. If you are desperate, you are a liability. The entire financial apparatus is engineered to funnel cheap capital toward those who have already proven they do not strictly need it. It is the ultimate financial paradox. As your net worth increases, the cost of borrowing plummets. The system rewards capital with more capital. The worker is penalized for their lack of leverage, charged exorbitant rates that ensure they can never save enough to buy an asset. Meanwhile, the owner is handed millions at a fraction of the cost, ensuring they can buy the exact assets that will make them even wealthier. The game is rigged by mathematical design. Look at the architecture of modern lending. For the average wage earner, it is a cold, automated landscape governed by ruthless algorithms. Your financial worth is reduced to a 3-digit FICO score. You interact with faceless apps that instantly approve you for high-interest credit cards with 25% APR. The environment is designed to be frictionless, encouraging impulsive borrowing that locks you into a cycle of endless minimum payments. The technology exists to capture your future wages as efficiently as possible. Step across the divide, and the environment changes completely. For the owner, lending is a bespoke service. It is private banking relationships, portfolio lines of credit, and custom interest rate swaps. You are no longer dealing with an automated app. You are dealing with a wealth manager whose sole job is to help you structure your debt to minimize taxes and maximize leverage. The financial architecture physically shifts to protect and expand your wealth, offering tools the working class does not even know exist. This brings us to the ultimate truth about borrowing. Debt is not a moral failing, nor is it a universal evil to be feared. It is simply a neutral financial instrument, a mechanical lever that amplifies whatever you attach it to. For the worker, it magnifies desperation, accelerating the drain on their future time and energy. For the owner, it magnifies leverage, accelerating the accumulation of wealth and financial independence. The tool is exactly the same. The only difference is who holds the handle. You have been told your entire life that debt is a disease and savings is the cure. It is a comforting narrative designed to keep you exactly where you are. The truth is that lie is quietly costing you millions. If you are trading your time for a paycheck, paying 30% in taxes and putting the leftovers into a high-yield savings account, you are not building wealth. You are slowly going broke, mathematically guaranteed. The architects of the global financial system do not save their way to the top. They use a completely different set of mechanical rules, rules you were never meant to see. To understand why your savings account is a trap, you first have to understand the invisible tax that is draining it right now. And more importantly, you need to see how the ultra-wealthy use the exact opposite strategy to legally erase their tax burden. Let us look at the mechanics of wage earning. You earn $1. The government takes its cut before that dollar ever hits your bank account. You are taxed on your production. You take the remaining 70 cents and put it in a bank. The bank then lends your 70 cents to an investor at a premium, pays you a fraction of a percent, and keeps the spread. Inflation then eats another silent percentage of your purchasing power every single year. This is the cash drag. It is a system designed to strip capital from the middle class and feed it to the owners. The owners do not hold cash, they hold assets, and to acquire those assets, they use the very thing you were taught to fear. But they do not use debt to buy televisions or cars. They use structural debt, and the way they deploy it turns a liability into the ultimate financial shield. When you borrow money, the IRS does not consider that loan as income. It is tax-free capital. The wealthy do not sell their assets to generate cash because selling triggers a capital gains tax. Instead, they borrow against their portfolio. They use the asset as collateral to secure a line of credit. The interest rate on that borrowed money is almost always lower than the historical return of the asset itself, and in many cases, that interest is tax deductible. This is the tax shield. They get the cash they need to live or invest further. The original asset continues to compound, and they pay zero income tax on the liquidity. It is a closed-loop system of infinite leverage. You are paying for your life with after-tax dollars. They are funding their empires with pre-tax debt. Understanding this spread is the intellectual bridge between being an employee and becoming an owner. But knowing the mechanics is useless if you are still trapped by the psychological barrier that keeps the working class poor. That barrier is lifestyle inflation. When a wage earner gets a raise, their expenses rise to meet their new income, a bigger mortgage. This is the opportunity cost of looking rich. Every dollar spent on depreciating liabilities is a dollar that cannot be deployed into an income-producing asset. The wealthy delay consumption. They build the machine first. They acquire real estate, businesses, and equities. They focus entirely on EBITDA and cash flow. They only consume when the cash flow from their assets can comfortably cover the cost of the luxury. The asset pays for the lifestyle. The wage earner pays for the lifestyle with their own sweat. Wealth is not about working harder. It is not about saving every penny. It is about systems. It is about understanding the velocity of money, the mathematics of compound interest, and the strategic deployment of capital. The rules of the game are written in plain sight. Stop playing by the rules of the wage earner. Start building the systems of the owner. The transition from wage earner to owner requires a fundamental rewiring of how you perceive risk. Society teaches you that all debt is inherently dangerous and must be eliminated at all costs. This is a deliberate simplification designed to keep the working class docile and debt-averse while the financial elites scale their empires. The reality is that debt is completely neutral. It is simply a multiplier of your existing financial strategy. If your strategy is consumption, debt will multiply your poverty. If your strategy is acquisition, debt will multiply your wealth. The wealthy do not fear debt because their debt is asset-backed. Asset-backed debt is the holy grail of financial leverage. When a worker borrows money, they secure it against their future labor. They are promising to trade thousands of hours of their finite life to repay a lender for a depreciating consumer good. When an owner borrows money, they secure it against a productive asset. The asset itself generates the revenue required to service the loan. The owner's personal time and labor are completely decoupled from the repayment process. This is the exact mechanism that allows wealth to scale infinitely, while wage labor hits a hard biological ceiling. Look at the physical landscape of any major metropolitan city. Every skyscraper, every massive apartment complex, every sprawling logistics center was built using asset-backed leverage. You are looking at billions of dollars of deployed capital, and almost none of it belongs to the developers. They did not save up their wages for 300 years to build a high-rise. They identified a cash-flowing opportunity, secured the rights, and brought in institutional debt to fund the construction. The concrete and steel around you are monuments to the power of using other people's money. Walk into any commercial bank and observe the stark divide in how they treat their customers. In the retail lobby, workers are interrogated over their FICO scores and squeezed for double-digit APR on personal loans. They are viewed as high-risk liabilities because their only collateral is their precarious employment. But upstairs, in the commercial lending division, the atmosphere shifts completely. Here, bankers court investors. They structure multi-million-dollar non-recourse loans based entirely on the projected net operating income of an asset. The bank is not betting on the borrower. The bank is betting on the math. To master this system, you must understand how commercial debt actually functions as a shield. When you use a mortgage to buy an apartment building, the bank is taking on the majority of the capital risk. If the property value plummets and the market collapses, a non-recourse loan ensures the bank can only seize the asset. They cannot touch your personal bank accounts. They cannot garnish your wages. You have effectively outsourced the catastrophic downside to the lender while retaining 100% of the upside potential. This asymmetric risk profile is how fortunes are built rapidly and safely. Furthermore, this debt acts as a massive tax shelter. The IRS taxes income, but it does not tax debt. When an owner's property appreciates in value, they do not sell it and trigger a massive capital gains tax bill. Instead, they do a cash-out refinance. They borrow against the new, higher equity of the asset. The bank hands them millions of dollars in tax-free cash. They use that untaxed capital to buy another asset, expanding their portfolio and increasing their cash flow. The tenant pays down the new loan, and the cycle repeats indefinitely. The mechanics of this maneuver require absolute precision. It begins with identifying an undervalued asset that can be forced to appreciate. You do not wait for the market to magically increase the value of the property. You force the appreciation by increasing the net operating income. You buy a mismanaged building, renovate the units, optimize the operations, and raise the rents to market rates. Because commercial real estate is valued based on a capitalization rate, every single dollar you add to the net operating income exponentially increases the overall value of the building. Once the value has been forced upward, the trap is set for the bank. You bring in an appraiser to document the newly stabilized higher value. You then present this to a commercial lender and request a refinance at 75% of the new appraised value. The bank issues a new loan that pays off the original acquisition debt and leaves a massive surplus of cash. You pull your original down payment out entirely. You now have infinite returns because you have zero of your own money left in the deal, yet you still own the asset and collect the monthly cash flow. The ultimate consequence of executing this debt-to-equity rotation is absolute financial sovereignty. You are no longer trading time for money. You have transformed yourself into a capital allocator. The worker remains trapped in a linear equation, praying for a 3% annual raise while inflation erodes their purchasing power by 6%. The worker is being quietly robbed every single day by a monetary system they refuse to study. The owner is immune. The owner's debt gets cheaper as inflation rises, and their asset values inflate in tandem with the money supply. This is the ruthless, mechanical truth of the global economy. Debt is the dividing line between those who rule the system and those who are consumed by it. If you continue to fear leverage, you will spend your entire life working to pay off the interest on someone else's assets. You must stop thinking like a consumer who borrows to buy liabilities. You must start thinking like an institution that borrows to acquire cash flow. The blueprint is right in front of you. The math is undeniable. It is time to stop working for the machine and start owning it. You have been conditioned to believe that debt is a disease. You were taught to pay off your credit cards, clear your mortgage, and live completely debt-free. It sounds responsible. It is also the exact reason you are stuck trading your time for a paycheck. The working class views debt as a penalty. The ultra-wealthy view debt as a tax-free instrument of acquisition. When you work for a wage, you are taxed on your income before you even see the money. You save the leftovers, put them in a bank account, and watch inflation quietly consume your purchasing power. You are playing a game with rules designed to keep you on the treadmill. But what happens when you stop looking at money as a reward for labor and start looking at it as a structural tool? The secret is not working longer hours. It is understanding the mathematics of the tax shield. When a billionaire needs cash, they do not sell their assets. Selling triggers a capital gains tax. The loan is not classified as income, which means it is entirely tax-free. They use that borrowed capital to acquire more cash-flowing assets, and the yield from those new assets pays down the interest of the loan. The principal continues to compound untouched. You might think this strategy is locked behind the gates of private banking, but the underlying mechanic is accessible the moment you shift your focus from earning a wage to building equity. The question is, how do you bridge that gap without getting crushed by leverage? It starts with recognizing the absolute opportunity cost of lifestyle inflation. Every dollar you spend upgrading your car or expanding your wardrobe is a dollar stripped of its future compounding potential. The wealthy do not buy luxury with their principal. They buy luxury with the cash flow generated by their assets. If you want to cross the divide between employee and owner, you have to weaponize your income. You build a baseline of assets. You let compound interest do the heavy lifting. You optimize your tax footprint by holding assets long term. You let the system work for you, rather than being the fuel that runs the system for someone else. Breaking out of the middle class is not about saving a few extra dollars on your grocery bill. It is about a fundamental rewiring of your financial psychology. It is the transition from trading time for wages to trading capital for wealth. The blueprint is already written. The math is absolute. The only variable left is whether you are willing to stop playing by the rules they gave you and start playing by the rules they actually use. The financial system does not operate on cash. It operates on credit. Cash is merely the byproduct of credit being deployed efficiently. When you deposit your paycheck, you think you are storing value. In reality, you are providing cheap liquidity to a bank. The bank then turns around and lends your deposited wages to an investor at a premium. That investor uses the borrowed capital to buy an asset that yields more than the interest rate. You are financing the wealth creation of the ownership class while your savings rot against inflation. This is the great illusion of modern banking. The institution needs your deposits not to keep them safe, but to use them as collateral to print new money. Fractional reserve banking means your single dollar is multiplied and weaponized by those who understand leverage. The worker is told that debt is a sin and savings are a virtue. The owner knows that debt is a tool and savings are a liability. The system relies on this asymmetry of information. If everyone understood the math, the engine would stall. You are taught to fear the very instrument the wealthy use to multiply their net worth. This fear is systematically programmed into you from your first credit card. You are given a low limit and a high APR. You are trained to view borrowing as a penalty for not having enough cash. The elite view borrowing as a strategy for never having to use their own cash. They use other people's money to acquire assets, and they use the income from those assets to service the debt. Let us look at the exact mechanics of a leveraged buyout. An investor spots a commercial property generating stable revenue. They do not liquidate their stock portfolio to buy it. They approach a lender. They present the cash flow of the target asset as the collateral. The bank underwrites the loan based on the property income, not the personal salary of the investor. The investor puts down a fraction of the purchase price, using borrowed capital for the rest. They control 100% of the asset while only risking 20% of the capital. Once the asset is acquired, the tenants pay the rent. That rent covers the mortgage, the maintenance, and the taxes. The investor pockets the difference. More importantly, as inflation drives up the value of the property and the cost of rent, the principal of the debt remains fixed. The debt is literally inflated away. The investor is paying back yesterday's borrowed money with tomorrow's cheaper dollars. This is the intended function of the credit market. The consequence of this strategy is exponential growth. When you use leverage to acquire cash-flowing assets, your return on investment is magnified. If a property appreciates by 5% and you bought it in cash, you made 5%. If you bought it with 20% down, your return on your actual invested capital is 25%. Leverage accelerates the timeline to financial independence, but it is a double-edged sword that demands extreme mathematical discipline. If you apply this exact same leverage to consumer goods, the math works in reverse. Financing a depreciating asset like a luxury vehicle destroys your wealth exponentially. The car loses value the second you drive it off the lot. The interest on the auto loan compounds against you. You are trapped paying a premium for an asset that is rapidly trending towards zero. This is the consumer debt trap. It is the exact inverse of the wealth-building equation, designed to keep you on the treadmill. The psychological toll of the consumer debt trap is devastating. It creates a perpetual state of financial anxiety. You wake up every morning knowing your labor is already spoken for. Your paycheck belongs to the credit card company, the auto lender, and the mortgage servicer. You are not working to build a future. You are working to pay off the ghosts of your past consumption. The stress of this reality hollows out your ambition and forces you into a defensive posture. Contrast this with the absolute serenity of the ownership class. When your debt is backed by cash-flowing assets, there is no anxiety. You are completely detached from the mechanical stress of survival. You sleep soundly knowing that while you rest, your capital is working, your tenants are working, the system is working to expand your equity. This peace of mind is the ultimate luxury, and it is entirely funded by the strategic application of leverage. To achieve this level of freedom, you must redefine your relationship with capital. Capital is not a reward for hard work. Every dollar that flows into your bank account must be deployed with lethal precision. You can no longer afford to let your money sit idle in a checking account. You can no longer afford to trade your liquidity for fleeting status symbols. You must become a ruthless allocator of resources. This requires a brutal audit of your financial habits. You must strip away the emotional attachment to spending. You must view every transaction through the lens of opportunity cost. If you deploy your capital on a consumer good, you must calculate the future revenue stream you are sacrificing. This is the mindset of a capital allocator. You stop thinking like a consumer who buys products. You start thinking like an institution that acquires cash flows. Look at the modern economic landscape. The physical world is entirely owned by those who mastered this math. The towering commercial real estate in your city center, the massive logistics hubs on the outskirts of town, the sprawling apartment complexes. None of these were built with saved wages. They were erected on mountains of strategic debt. They are monuments to leverage. They stand as physical proof that capital, when paired with credit, can reshape reality itself. The infrastructure of wealth surrounds you every single day. You walk through it, you drive past it, and you pay rent to it. The entire built environment is a massive mechanism designed to capture cash flow and service debt. You can choose to remain a participant in this machine, feeding it with your labor and your consumption. Or you can step outside the matrix of the working class. You can acquire the knowledge, secure the leverage, and start building your own monuments. You have been told your entire life that being completely debt-free is the ultimate financial goal. You have been taught that paying off your mortgage early, cutting up your credit cards, and saving your way to $1 million is the path to freedom. It is a carefully packaged, highly profitable lie designed to keep you trading your time for wages until the day you die. The ultra-wealthy do not avoid debt, and until you understand the mechanics of how they do this, you will remain on the wrong side of the wealth gap. The difference between the working class and the owning class comes down to a single fundamental misunderstanding about the nature of money. To bridge that gap, we have to look at the invisible tax you pay every time you follow traditional financial advice. When a wage earner gets a raise, their lifestyle expands. A better car, a bigger house, a higher standard of living. This is lifestyle inflation, and it is the silent killer of capital. You work harder, you earn more, and your tax bracket creeps higher. You take whatever is left after the government takes its cut, and you put it in a savings account earning a fraction of a percent. Meanwhile, inflation erodes your purchasing power at a staggering rate. You are mathematically guaranteed to lose. You are playing a game of addition, while the financial elite are playing a game of multiplication. So how exactly do they multiply wealth without triggering massive tax liabilities? The secret lies in structural debt strategy. When an owner needs capital, they do not sell their assets. Instead, they borrow against those assets. Debt is not taxable income. If you hold a portfolio of assets and take out a loan against it, the IRS cannot tax that money. You have just accessed liquidity completely tax-free. You use that untaxed capital to purchase more income-producing assets, which in turn cover the cost of the debt. This is how a tax shield works. It is not magic. It is cold, calculated financial mechanics. But accessing this system requires a fundamental shift in how you view leverage. Most people view leverage as a consumer trap because they use it to buy depreciating liabilities. The wealthy use leverage to buy cash flow. If you can borrow money at a 4% APR and deploy it into an asset yielding 8%, you have created a permanent wealth machine. You are capturing the spread. This is financial arbitrage. The bank gets their fixed return, and you keep the infinite upside. Combine this with the mathematics of compound interest, and your wealth begins to scale autonomously. Your money works 24 hours a day. It does not sleep, it does not take vacations, and it does not ask for a raise. But to build this machine, you have to stop thinking like an employee. The transition from wage earner to wealth owner is not about working harder. It is not about saving the cost of a daily cup of coffee. It is about understanding the velocity of money, optimizing your tax footprint, and acquiring assets that outpace the erosion of fiat currency. The financial system is a machine. You can either be the fuel that powers it for someone else, or you can be the architect who controls the levers. Realizing you are nothing but collateral is a bitter pill to swallow. Every time you sign a 30-year mortgage or a 5-year auto loan, you are pledging your future labor to an institution. You are literally selling decades of your life, waking up every morning to generate the cash flow that services their balance sheet. The anxiety you feel about losing your job is not just fear of failure. It is the crushing weight of knowing you are trapped in a contract where your survival is secondary to their profit margins. You are not the owner of your life. You are an indentured servant to a mathematical formula. This psychological burden is entirely by design. The system thrives on your quiet desperation. When you are burdened by consumer debt, you cannot take risks. You cannot walk away from a toxic boss, and you cannot start the business you have been dreaming about. Your creativity and ambition are suffocated by the monthly minimum payment. The trap forces you to play it safe, keeping you obedient, predictable, and consistently profitable for the very institutions that lock the cage. They do not just own your debt, they own your choices. Breaking out of this psychological prison requires understanding the true nature of lending. Banks do not want to hold your consumer debt because it is inherently risky. They tolerate it because the interest rates are extortionate. But what institutions truly desire is collateralized lending against hard, appreciating assets. They want to lend millions to the investor holding commercial real estate, not thousands to the worker buying a television. The transition from consumer to owner begins the moment you stop borrowing to consume and start borrowing to acquire. You must flip the script on the underwriter. When you walk into a bank as a worker, you bring them a liability and a promise to work hard. When you walk in as an owner, you bring them an asset and a mathematical certainty. You are no longer begging for a lifeline. You are offering them a secure place to park their capital in exchange for a modest yield. This power dynamic dictates everything from your approval odds to the terms of your contract. You stop being the product and start becoming the partner. Step inside the reality of global credit markets, and you will find a landscape devoid of emotion. It is a digital ocean of moving capital, constantly seeking the path of least resistance and highest security. Trillions of dollars flow daily through servers in financial districts, indifferent to human struggle. In this environment, a FICO score is just a crude filter for the masses. True wealth operates in a completely different tier of this ecosystem. Here, capital is abundant, cheap, and aggressively looking for competent operators to deploy it. The air in this upper tier of finance is thin, but the rules are remarkably simple. It is a world governed by loan-to-value ratios, debt service coverage, and capitalization rates. The institutions operating at this level do not care about your personal passion or your work ethic. They only care about the cash flow your assets produce and the structural integrity of your collateral. It is a brutal, beautiful meritocracy of numbers. If the math works, the vault opens. If the math fails, the conversation ends. At the core of this environment is the concept of interest. For the worker, interest is a penalty for spending money they do not have. For the owner, interest is simply the cost of renting capital. It is a business expense, entirely deductible and perfectly predictable. If renting $1 million costs $50,000 a year in interest, but that million generates $100,000 in new revenue, the interest rate is irrelevant. The owner has manufactured $50,000 out of thin air. This is the ultimate systemic advantage. Understanding this turns the crushing weight of debt into the very engine of your financial liberation. You are losing money every time you put $1 into a traditional savings account. The financial industry has sold you a lie. They tell you to work hard, save your pennies, avoid debt at all costs, and eventually you will be rich. That is a blueprint for mediocrity. It is the exact formula designed to keep you a wage earner forever, quietly funding the very system that extracts your wealth. The wealthy do not save their way to prosperity. They engineer it, and they do it by doing the exact opposite of what you were taught in high school economics. They embrace the one thing you have been conditioned to fear. You have been lied to about the fundamental nature of money. Your entire life, you were told that the ultimate financial achievement is to be completely debt-free. Pay off your house, save 10% of your paycheck and wait 40 years. But if debt is the enemy of wealth, why do the richest people on the planet carry billions of it? The answer exposes the brutal, mechanical reality of the global financial system. There are two rule books. One is written for the wage earner, the other is written for the owner. And until you understand the mechanics of the latter, you will remain trapped in the former. Your financial foundation is built on a lie. You were taught that the ultimate goal of adulthood is to be completely debt-free, pay off the house, cut up the credit cards, and save whatever is left. It is also the exact formula keeping you in the middle class. The ultra-wealthy do not fear debt. While you are trading hours for a paycheck and handing 30% of it straight to the government, the architects of the global economy are playing a completely different game. They know something you do not. Cash is a liability, and strategic debt is a tax-free asset. The moment you understand this, the illusion of the traditional savings account shatters. But how exactly do the elite borrow their way to billions without collapsing under the interest? The answer lies in the mechanics of the tax shield. The most dangerous financial advice you will ever receive is to work hard, save a portion of your paycheck, and wait. That is not a wealth strategy. That is a blueprint for managed poverty. The middle class trades time for a wage, pays taxes on the gross, and desperately hoards whatever is left. The wealthy do the exact opposite. They understand a mechanical truth about capital that makes the traditional paycheck entirely obsolete. To understand how they break the cycle, you have to look at the invisible force actively destroying your purchasing power. Your wage is linear. It is capped by the hours in a day and your physical endurance. But the economic system you live in operates on an exponential curve. Every dollar sitting idle in a traditional savings account is actively losing value. Inflation is not a political talking point. It is a mathematical certainty. It is a silent wealth transfer from the saver to the borrower. When you save, you are lending your capital to a banking system that immediately deploys it into high-yield assets. They pay you a fraction of a percent while they harvest the spread. You are financing their wealth creation. So, if saving is a trap, how exactly do the ultra-wealthy acquire assets without draining their own liquidity? The answer lies in the strategic weaponization of debt. You have been conditioned to believe that a high salary makes you rich. In fact, chasing a bigger paycheck is the exact mechanism keeping you broke. The system is operating perfectly, and your W-2 is the anchor. Look at the tax code. It is not a set of rules meant to punish you. It rewards behavior the government wants to encourage, and it penalizes the rest. When you trade your time for a wage, you are penalized with the highest tax brackets in existence. You generate value, the government takes its cut off the top, and you are left to build a life with the scraps. But the people signing your paycheck do not play this game. They do not accumulate wages, they accumulate assets. And the difference between those two words is the difference between working until you die and buying your true autonomy. So how do the architects of the financial system actually extract money without triggering the tax trap? You are sacrificing your freedom on the altar of a zero balance. Society trained you to view debt as a moral failing and a $0 credit card statement as the ultimate financial victory. But while you are emptying your bank account to pay off a mortgage or a car loan, the ultra-wealthy are quietly doing the exact opposite. They are borrowing millions, paying zero in income tax, and using the exact same banking system you use to build an impenetrable fortress of wealth. The gap between your paycheck and their portfolio has nothing to do with saving harder. It is entirely about how you have been programmed to misunderstand the mechanics of money. To break out of the wage cycle, you have to stop thinking like a consumer trying to escape debt and start thinking like an institution using it as a weapon. How exactly do the architects of modern wealth turn borrowed money into generational power without triggering a single tax event? The answer lies in a structural mechanism known as a tax shield. As an employee, you generate income through labor. That labor is taxed at the highest possible marginal rate before you even see the deposit. You take what remains, pay your living expenses, and maybe put a fraction into a savings account, earning a microscopic yield. When you need a large sum of cash, you sell an asset or work more hours, triggering yet another tax event. This is the wage trap. It is a closed loop designed to bleed your capital through taxation and inflation. The wealthy do not operate in this loop. They do not sell assets to generate cash. They borrow against them. When an owner holds a portfolio of appreciating assets, they pledge those assets as collateral for a line of credit. The cash they receive from the bank is not classified as income. It is classified as debt, and debt is not taxable. This is the invisible pivot point of the global financial system. While the middle class uses debt to buy depreciating liabilities like televisions and vacations, the elite use debt to access the liquidity of their assets without ever interrupting the compound interest curve. But accessing tax-free capital is only half the equation. The real question is how they force that borrowed money to pay for itself. You have been lied to about the nature of debt. Since childhood, you were taught that owing money is a moral failing and a financial death sentence. You were told to pay off your mortgage, cut up your credit cards, and save your way to freedom. But while you were busy trying to reach a zero balance, the ultra-wealthy were doing the exact opposite. They are accumulating massive, structured debt, not to buy depreciating liabilities, but to shield their wealth from the single greatest threat to your net worth. The middle class operates on a fundamental misunderstanding of how fiat currency actually works. You are trading the only non-renewable resource you have, which is your time, for a wage. That wage is immediately penalized, taxed at the highest marginal rate by the government. You take the remainder, put it in a high-yield savings account, and wait. But inflation is a silent systemic tax on liquidity. Your purchasing power bleeds out while you sleep. The mathematics of saving your way to wealth are broken by design. It is a system built to keep you working. So how do the architects of the financial system escape this cycle? They stop earning income. Your paycheck is not a measure of your value. It is a precise mathematical calculation of how much it costs to replace you. If you are sitting in a comfortable job, saving 10% of your income, and waiting for the miracle of a corporate promotion to make you rich, you are falling for the most successful financial illusion of the modern era. The middle class is obsessed with income. We are taught that the path to prosperity is a staircase of incremental raises, but earned income is the most highly taxed and highly vulnerable form of money in existence. When you trade time for wages, you are selling a finite resource at a wholesale discount. This is why a surgeon making $500,000 a year can still live paycheck to paycheck. They upgrade the zip code, they upgrade the car, they inflate their lifestyle to match their tax bracket, completely ignoring the opportunity cost of that capital. They are playing the exact same game as the entry-level worker, just on a much more expensive board. So, if a high income is not the answer, what exactly separates the working rich from the truly wealthy? You are currently losing a game you do not even know you are playing. For your entire life, you have been told that the path to financial freedom is simple. Work hard, save a portion of your paycheck, avoid debt, and eventually, the math will reward you. It is a comforting narrative. It is also a mathematical trap designed to keep you exactly where you are. The truth is, the middle class saves to consume, while the ultra-wealthy borrow to own. If you are relying on a W-2 to build generational wealth, you are fighting gravity. Let us look at the cold mechanical reality of your paycheck. When you sell your time for a wage, you are participating in the most highly taxed, least efficient financial transaction legally available. The government takes its share before the money ever hits your bank account. Then, inflation silently erodes the purchasing power of whatever is left. You try to bridge the gap by cutting expenses or saving a little more each month, but you cannot budget your way out of a fundamentally broken equation. The opportunity cost of lifestyle inflation keeps you running on a treadmill, burning energy just to stay in the exact same place. You are trading a non-renewable resource, your time, for a depreciating asset, fiat currency. So if saving your leftover wages is a guaranteed path to mediocrity, what is the actual mechanism driving the wealth gap you have been lied to about the fundamental purpose of a dollar? You were told that wealth is the result of working hard, spending less, and putting whatever is left into a savings account. That is a containment protocol. It is a mathematical certainty designed to keep you exactly where you are. The middle class operates on a fatal equation: time equals money. You trade hours for wages, pay the highest marginal tax rate legally permissible, and try to outsave inflation. It does not work. When the inflation rate outpaces your bank yield, your savings account is just a slow-motion incinerator for your purchasing power. The financial system relies on you believing that hoarding cash is safety. But cash is not a store of value. It is a depreciating medium of exchange. The wealthy do not hoard cash. The question is, what do they know about the mechanics of money that you do not? Your savings account is quietly bleeding you dry, and the financial advice you follow was designed to keep it that way. You have been conditioned to believe that if you just cut back on expenses, max out your 401k, and wait 40 years, you will eventually become wealthy. That is the great middle-class lie. It is a mathematical impossibility designed to keep you functioning as a highly efficient gear in someone else's wealth machine. The ultra-wealthy do not save their way to the top. They engineer their way there. Let us look at the highest paid employee you know: the doctor, the corporate lawyer, the executive pulling in $500,000 a year. Society calls them rich. The tax code calls them prey. Earned income on a W-2 is the most heavily taxed, least protected money in the global financial system. Every dollar you trade for your time is stripped of its power before it ever hits your bank account. You are fighting a war of attrition against inflation and the IRS, and you are doing it with one hand tied behind your back. But what if the game was rigged in the opposite direction? What if the very system draining your paycheck could be inverted to protect it? For decades, the middle class has been programmed to believe that the pinnacle of success is being completely, 100% debt-free. It feels secure, and it is exactly what keeps you working until you are 65. The truth is, paying off every cent you owe is the most expensive financial mistake you can make. The global financial system is not designed to reward the debt-free. It is designed to reward those who know how to weaponize leverage. Let us strip away the polished lies of traditional financial advice. The wage earner views debt as a prison. They see a mortgage, a car loan, or a credit balance as a moral failing that must be eradicated with extreme prejudice. They cut expenses, live beneath their means, and throw every spare after-tax dollar at their principal balance. But the wealthy view debt entirely differently. They do not see it as a burden. They see it as a tax shield. They see it as a mechanism to acquire cash-flowing assets without deploying their own capital. The divide between the middle class and the ultra-wealthy is not just a gap in income. It is a fundamental difference in how they interact with the banking system. If you are using your own money to build wealth, you are already losing the game. The question is, how do the architects of wealth use the bank's money to generate infinite returns? Making $200,000 a year does not make you wealthy. It makes you a highly compensated liability. You are trading time for a premium wage, paying the maximum possible tax rate, and financing a lifestyle that systematically drains your liquidity. The modern financial system is perfectly designed to keep high earners trapped in this cycle, convinced that the next promotion or the next bonus will finally be the key to financial freedom. The gap between the middle class and the ultra-wealthy is not created by a difference in work ethic. It is created by a fundamental difference in how money is structured. You have been taught to view debt as a moral failing and cash as a safe haven. The wealthy view cash as a melting block of ice and debt as a surgical tool. When the middle class gets a raise, they increase their borrowing capacity to consume. They buy a larger primary residence, a luxury vehicle, or a premium vacation. They pay for these depreciating liabilities using after-tax dollars. When the wealthy want to expand their lifestyle, they do not spend their own money. They acquire an asset that generates cash flow, and they use the cash flow from that asset to fund their consumption. But the real divergence between a wage earner and an owner is not just about buying assets. It is about how the elite use the banking system to erase their tax burden entirely. You have been conditioned to believe that your salary is a measure of your financial success. Your salary is actually the most expensive money you will ever earn. Every dollar you trade for hours is penalized at the highest possible rate before it even hits your bank account. You are playing a game where the rules were written to keep you exactly where you are. But there is a different game happening right above your head. Society tells you to work hard, save a fraction of your income, avoid debt, and wait 40 years. That is the blueprint for a comfortable retirement if absolutely everything goes perfectly. It is also the exact opposite of how true wealth is built. The wage earner views money as a reward for labor. The wealthy view money as a raw material for systems. When you get a raise, your tax burden increases. When an owner's asset appreciates, their borrowing power increases, completely tax-free. The gap between you and the ultra-wealthy is not a lack of saving. It is a fundamental misunderstanding of structural debt. You have been taught to fear debt as a trap. The financial elite use it as a shield. How exactly does borrowing money create permanent, untaxed wealth? You have been lied to about the fundamental purpose of a savings account. Society tells you that tucking away a portion of your paycheck into a bank is the responsible path to financial freedom. It is a mathematically guaranteed formula for a slow, comfortable decline into the middle class, while you are trading your time for a wage, paying the highest possible tax rate, and letting inflation quietly erode your purchasing power. The ultra-wealthy are playing an entirely different game. They do not save their way to wealth, and they do it using the exact financial mechanisms you have been taught to fear. Let us look at the cold mechanics of a standard wage. You earn income. You pay your living expenses with what is left. Then, you save the remainder. You are fighting a war on two fronts, the tax code and inflation. If inflation sits at a historical average and your savings account yields less than that, your money is actively dying. You are losing purchasing power every single day. The wealthy understand this. They know that earned income is the most heavily taxed and least efficient way to build capital, so they stop focusing on earning a higher wage and start focusing on acquiring assets. But how do they acquire those assets without draining their own capital? The answer lies in a mechanism the middle class avoids at all costs. You have been lied to about your savings account. Every time you deposit a portion of your paycheck, you feel responsible, but you are actively participating in the quiet confiscation of your own wealth. The financial industry wants you to believe that patience and a high-yield savings account are the keys to a comfortable retirement. They are the exact mechanisms designed to keep you working until you die. So, if saving money is a mathematical trap, what exactly are the ultra-wealthy doing with their cash? To understand the wealth gap, you have to stop looking at income and start looking at the velocity of money. When you trade your time for a wage, you are taxed at the highest possible rate. You take what remains, pay for your life, and put the surplus in a bank. The bank then leverages your surplus, lending it out at higher rates, keeping the spread, and handing you a fraction of a percent. Meanwhile, inflation erodes the purchasing power of that stagnant capital. You are bleeding out from 1,000 invisible cuts. You are playing a game of addition while the system plays a game of multiplication. The middle class tries to out-earn this decay by working harder, chasing promotions, and upgrading their lifestyle. But lifestyle inflation is just another tax on your future. A nicer car and a bigger mortgage do not build wealth. They build a gilded cage. Breaking out of that cage requires a fundamental shift in how you view debt. The very thing you were taught to avoid at all costs is the exact tool the 1% uses to multiply their net worth. The most dangerous financial lie you have ever been told is that the ultimate goal in life is to be completely debt-free. You have been conditioned to view debt as a moral failing, a weight around your neck that must be eliminated before you can finally build wealth. That is the philosophy of the working class. It is a psychological cage designed to keep you trading your time for taxed wages, while the global financial elite play an entirely different game. The truth is, the wealthiest individuals on the planet do not avoid debt. Look at the standard middle-class playbook. You earn a salary. The government immediately takes 30 to 40% in income taxes. You take the remainder, pay your living expenses, and aggressively funnel your surplus cash into paying off your mortgage. You are systematically destroying your own liquidity to lock your capital inside dead equity that pays you nothing. You are starving your money of its ability to compound, all for the emotional comfort of a zero balance. But if the traditional path of saving your way to wealth is a mathematical dead end, how exactly do the architects of the modern economy finance their empires without draining their net worth? You have been taught that the safest place for your money is a bank account. You have been told that if you work hard, live below your means, and put a little away each month, you will eventually be wealthy. That is a mathematically engineered lie. It is a system designed to keep you a perpetual employee, trading the most valuable asset you have, your time, for a currency that loses value every single second. It sits still. The middle class operates on a fundamental misunderstanding of money. You view cash as a destination. The ultra-wealthy view cash as a liability. When you deposit your paycheck into a savings account, you feel responsible. You are actually funding the very system that prices you out of the market. Banks do not hold your money in a vault. They leverage it. They lend your deposits to the wealthy at an APR that allows those investors to buy income-producing assets. You get a microscopic yield. They get equity, cash flow, and tax advantages. You are absorbing all the inflation risk while they harvest all the upside. But the gap between you and them is not just about capital. It is about a completely different understanding of structural debt. The ultimate middle-class dream is a lie. You were told that the pinnacle of financial success is a paid-off mortgage, zero credit card balances, and a savings account gathering dust in a local branch. You have been conditioned to believe that eliminating debt is the finish line of personal finance. But while you are aggressively paying down debt, the ultra-wealthy are aggressively acquiring it. Society trains employees to view debt as a moral failing. You work for a wage, you pay taxes on that wage, and you use the leftovers to chip away at your liabilities. It is a mathematical trap designed to keep you trading time for money until you die. But if debt is so dangerous, why do the richest families on earth hold billions of it on their balance sheets? The answer lies in a cold, mechanical difference in how money is taxed and deployed. When you understand the architecture of systemic leverage, everything changes. You were taught that wealth is the reward for working hard, saving diligently, and avoiding debt at all costs. But look around. The people working the hardest are often the furthest from financial freedom. That is because the middle class plays by a set of rules specifically designed to keep them dependent on a paycheck. The ultra-wealthy are playing an entirely different game. To cross the chasm from wage earner to wealth owner, you have to unlearn the polished lies of the financial entertainment industry. It starts with understanding the mechanical difference between how you are taxed and how capital is taxed. Every time you get a raise, you are actually losing ground. You have been taught that the path to financial freedom is to work harder, secure a higher salary, and save what is left. That is a highly efficient tax trap designed to keep you trading your time for a depreciating asset. The global financial system does not reward labor, it rewards ownership. Let us look at the cold mechanics of your paycheck. As an employee, you generate value. The system takes its cut through income tax before you ever see a single cent. You are taxed at the highest possible rate, leaving you with the leftovers to fund your life. And when you finally manage to scrape together a surplus, you put it in a traditional savings account where inflation quietly erodes its purchasing power. You are playing a game with a mathematically guaranteed ceiling. You can only work so many hours. You can only secure so many promotions. So why is it that those at the very top seem to multiply their net worth without ever drawing a traditional salary? You have been told since childhood that paying off your house and living completely debt-free is the ultimate financial finish line. That is a mathematically flawed narrative designed to keep you trading your time for a paycheck. The middle class avoids debt at all costs. The ultra-wealthy use it as a tax-free engine for infinite wealth generation. Look at the anatomy of a standard paycheck. You earn a wage. The government takes its cut before the money ever hits your account. You take what is left, pay your living expenses, and put the remainder into a savings account earning a fraction of a percent. Meanwhile, inflation silently erodes your purchasing power. You are running on a treadmill that is speeding up, wondering why you are losing your breath. This is the opportunity cost of playing by the rules. You are playing a game of simple addition, while the financial elite are playing a game of exponential multiplication. You have been programmed to believe that being completely debt-free is the ultimate financial finish line. It is a comforting thought. It is also a mathematical trap designed to keep you trading your time for a paycheck until the day you die. The people who own the buildings you work in are swimming in debt. They are doing it on purpose. And until you understand exactly why, you will remain on the wrong side of the wealth divide. The modern worker is fed a strict diet of financial anxiety. Cut your expenses. Save a fraction of your income. This is the gospel of the middle class. But this strategy is fundamentally flawed because it ignores the silent killer of wealth, which is opportunity cost. When you lock every spare dollar into paying down low-interest consumer debt or a primary residence, you are burying your capital alive. You are building debt equity. This is equity that produces no income, generates no yield, and sits paralyzed while inflation quietly erodes its purchasing power. You are playing defense in a game where the victors only play offense. So if paying off debt is the wrong target, what exactly are the ultra-wealthy doing with the billions they borrow? Your salary is a trap. It does not matter if you make $50,000 a year or $500,000. If your primary source of money is a paycheck traded for hours of your life, you are playing a rigged game. Society tells you that a high income equals wealth. That is a polished lie. A high income just makes you the most lucrative, defenseless target in the global tax code. The wealthy do not want a high salary. In fact, they actively avoid it. You have been taught to work hard, save 10%, avoid debt, and wait 40 years. But if the people controlling the global economy do the exact opposite, what do they know that you do not? Your paycheck is not a building block for wealth. It is a highly engineered anesthetic designed to keep you comfortable enough to never question the system, but poor enough to never leave it. You have been told that if you work hard, save 10%, and avoid expensive coffee, you will eventually become rich. That is a mathematical fiction. The gap between the middle class and the ultra-wealthy is not a difference in saving habits. It is a fundamental difference in financial mechanics. To bridge that gap, you have to stop looking at your salary as the finish line and start seeing it as raw material. But before you can build the machine, you need to understand exactly how the current system is draining you dry